All right, I think we'll go ahead and get started. A couple of folks may still be trickling in, but that is fine. Welcome everyone to the fifth session of our budget webinar series here at FFJC. My name is Lillian Patil. I am a senior analyst of state and local budgets at FFJC, where we work across the country with affected communities and justice system stakeholders to empower efforts to end fees in the justice system and ensure that fines are fair and equitably imposed. For those of you who are joining us for the first time, we run these budget webinars to give you as advocates and stakeholders knowledge about public budgeting processes and tools that you can use to help maximize the success of your fines and fees or other social justice reform campaigns. After 5 years working in state and local budget offices, I have seen firsthand countless times the immense power that the public budgeting process can have on the ability to implement real and concrete successful social change. And so through these webinars, we strive to make sure that you all can access fully that power as well and use it to help you advance your reforms. Today, we're going to be discussing something that I imagine is top of mind for many of you who are especially heading into legislative sessions around the country, and that's navigating the revenue impact of reform. I know that most of the folks watching are not going to be the people in the fiscal offices, the policymakers who are in charge of balancing budgets and figuring out all the right revenue solutions, but those of you who are working on advancing fines and fees reform campaigns very well may hear, and maybe increasingly this year, conversations, concerns about revenue impacts that may come along with those reforms and how to deal with them. So our goal today is to make sure that you have some strategies and concrete tools and information to help you navigate those conversations, mitigate concerns about revenue impacts of fines and fees reform, and make sure that they're not a full stop obstacle to your fines and fees reform campaign. A reminder today to folks that we are recording this session, so it will be free and accessible on our FFJC YouTube channel, which our lovely comms team will put in the chat for you to access anytime, as well as our 4 previous budget webinars. Today, the goals for our session are to understand first why fines and fees reforms even have revenue impacts in the first place, why those revenue impacts are often overblown, and why often they may not exist at all. And then we will go ahead and talk through how governments can mitigate revenue impacts, both through strategies that involve finding new money, but also strategies that involve not finding new money. And then we will lastly discuss some strategies around backfilling or replacing lost revenue that may result as a result of a fines and fees reform. And I'm really excited that we have with us here today Kamolika Das, who is the local policy director of the Institute of Taxation and Economic Policy, or ITEP. And she has years of tax policy expertise that she's going to bring to this conversation a little bit later in the presentation and talk to us more about alternative tax streams that we're seeing in local and states governments right now that might be in conversations when talking about how to deal with revenue impacts, how to generate and backfill new revenue, et cetera, and how to think about those different tax streams if you're in those conversations. All right. Before we get started, last note that we also put in the chat, the Q&A function is open throughout, so please feel free to put your questions in that Q&A chat. We'll try and answer as we go if we can. If we don't get to them, we will leave a few minutes at the end of this webinar to make sure that we both can answer any questions that y'all have. Okay, so let's start out with some basic framing and reminders around why fines and fees reforms may impact revenue in the first place. And the simple answer to this is that governments do and long have both explicitly and implicitly used fines and fees revenue and collections to generate revenue and generate funding for their budgets and generate money for all the different things that government needs to run. And that system happens at a very basic level, first by courts or other public agencies collecting fines and fees from people who are involved in the criminal legal system at virtually every single aspect of that system. When fines and fees are collected, the money usually then flows into some sort of state, federal, or local revenue fund, which is like a term for government bank accounts, that then public agencies can access as needed and as they are authorized in the budget to use to cover planned spending, operations, payroll, all the things they need to run to fulfill their mission as agencies and fulfill their public services. And so therein, this system sort of lays bare one of the most fundamental problems with the way that fines and fees work in our criminal legal system, and that is that governments and agencies are forced to depend on and hope for people to continue committing crimes and being involved in the criminal legal system in order to fund government operations. Because if people are not interacting with the criminal legal system, then fines and fees can't be collected and brought in as revenue and directly used to fund all the different things that governments want to use it to fund their operations. And so when we as advocates, especially fines and fees reform advocates, come in and try and push for reforms that change those revenue streams, that may eliminate a fine or a fee or change the amount of money that may be coming in as revenue, lawmakers and policymakers may become concerned that there may be a revenue impact or money lost, creating sort of a hole in the budget where fine and fee dollars were originally used to cover a certain type of government service or operation and no longer have the money available to do that. And so it is very helpful, I think, for all of us as advocates and stakeholders to be aware of sort of how those revenue impacts can come up, how they can be overblown, and how they can be worked through to mitigate concerns about them to still be able to successfully advance reforms. All right, so what I want to bring first and foremost to the conversation when we start talking about revenue impacts is the very real fact that just because there is a revenue impact associated with the fines and fees reform does not mean the sky is falling. And that's for a number of reasons. One is that fines and fees are just one of many, many government revenue streams. And in the grand scheme of all the different kinds, flavors of money and revenue that come into a state or local budget, fines and fees tend to be a very small amount. And so the relative cost to the government of dealing with the revenue impact, even if there is one for fines and fees, is usually literally a drop in the bucket compared to an overall agency budget or overall general fund or operating budget of a government. On the flip side, the benefits that we know that happened for community members and people from whom that money was being extracted when a fine or fee is eliminated tends to be tremendous and have lifelong positive benefits and consequences. And so in that cost benefit analysis, usually the cost, that relative cost to the government just really is a drop in the bucket, is quite small. Additionally, when a fiscal note comes up with a projected revenue impact, so a like revenue loss number that would result as a result of legislation that eliminates a fine or fee, or there's a projected revenue loss number out there, a lot of times that number can be overstated, inflated. Sometimes it might not even be virtually existing at all. And there are a few different reasons for that. One of which, of course, is low collections rate. It's no secret that fines and fees collections often occur at a very low rate compared to what is assessed. And that makes sense because we're largely trying to extract money here from populations who are disproportionately low income, who largely cannot afford to pay it in the first place. And so if you're not collecting very much coming in, that revenue stream that government is using to fund services is probably going to be pretty small. Also, a lot of times, initial revenue impact projections take into account revenue loss assumptions, but don't necessarily take into account the equally important savings that result when you stop having to maintain the status quo of how a fines and fees system is working. And so this covers everything from costs of collections, the expensive time and resources it takes to try and collect fines and fees from justice-involved people, to the very expensive cost of incarcerating people for non-payment of fines and fees, to the costs that governments incur in their social safety net service programs, such as food assistance or housing assistance that people might be needing to apply for, who might not need to use that public service program if they could instead keep the income that they were using to pay for their fines and fees and use it to cover basic household expenses like food and rent. So all of these things often can add up to a big savings that can offset, sometimes partially, sometimes completely, the revenue impacts or loss that comes from no longer collecting a fine or fee the same way that it was being collected before reform. And then, of course, another important thing to take into account is volatility over time. And this has to do with looking not just in 1 year, but year over year for a multi-year period. even if there's money coming in from a certain fine or fee, if the amount of money coming in and being generated and used as revenue by governments rises and falls a lot, or if it consistently declines over time, that spells a risky revenue source for governments to depend on, because government expenses often stay continuous or increase year after year. And governments want to be able to depend on revenue dollars coming in, again, consistently or maximized year over year. And so a declining or volatile revenue source makes for a risky one for governments. And so the bottom line at the end of the day, ending fine and fee revenue streams is often best for people and best for budgets. And I feel like in these fears and concerns and conversations about revenue impacts of reform, sometimes that sort of like bottom line can get lost. And it's an important one to just lift up first and foremost to have in the framing of all the conversations you have. So with that said, I do want to acknowledge that this year in particular, and I think this legislative session and this like budget process development cycle in particular, compared to the last few years, we are seeing some tighter fiscal conditions that are making lawmakers and policymakers more cognizant of and more concerned about revenue impacts from different pieces of legislation that they might be considering passing, including fines and fees reforms. And this does not necessarily mean to say that like budgets are in trouble or the economy is in trouble, because on the contrary, most state and local reserves are still in a really robust place. I think a recent NASBA report put the most recent general fund revenues for states at like 38% above where they were pre-pandemic in fiscal year 2019. What's really happening is that we're seeing fiscal conditions after a few very unprecedented years return to quote unquote normal or like precedented times. And what that means is compared to these last few years where there was just a lot more cash flow going on, times look a little tighter and budgets may be needing to deal with some new deficits that they didn't before, which may involve cutting some levels of spending and just creating new concerns about revenue. And that's for a number of reasons, a big one of which is the end of one-time pandemic federal aid that got funneled by the federal government into state and local governments over the last few years as a response to the impact of COVID. And that created just a huge amount of cash flow and new money to do things with that, again, was one time. And so now it's largely running out, which isn't necessarily a bad thing, but it does mean that the levels of resources that governments have to work with this year compared to last year, the last couple of years, is changing. In addition to that, in the last few years, a lot of state governments in particular implemented a lot of different tax cuts to relieve burdens for taxpayers, which are now continuing even after these few sort of cash flush years, are now continuing to be implemented and factoring into what we're seeing in terms of some revenue growth slowing, which doesn't necessarily mean revenue decline, but again, compared to those previous years, making revenue look a little different. And then, of course, there is definitely uncertainty with the new federal administration around future federal revenue streams and how those federal dollars are going to be flowing into state and local budgets for the next year and in the immediate future. All these things, again, making lawmakers, I think, more cognizant about revenue concerns, looking for ways that they can mitigate those concerns. And so as advocates, as stakeholders, when you're having conversations about fines and fees reforms and possible revenue impacts, it is useful to be prepared to have these conversations, to have some tools, strategies, and information in your back pocket to help not necessarily solve a revenue problem, but to mitigate concerns that you may find policymakers having about your reforms and make sure it can kind of get over that fiscal no revenue impact stage of a successful reform campaign. So we're going to get into sort of the nitty-gritty of that now, which is all about identifying and mitigating possible revenue impacts of fine and fee reforms. And the first step in that process is, of course, to figure out how big of a revenue impact are we actually looking at for a particular fine or fee reform that you are working on. And that involves figuring out where the revenue is currently going and how much is actually currently going there. And I'm not going to talk about this topic anymore in this webinar because we actually do have 2 previous webinars that go way more into depth on this exact topic. So if you want to learn more and get some like very in the weeds technical tips and tricks for how to do this, we recommend going back and watching our webinars on following the money and how to analyze a fiscal note, which will give you a full 2 hours of more in-depth strategies and discussions on these topics. And our comms team is going to go ahead and put the link for those in the chat so that you can access it. But as you're doing this process, it is important, of course, as I mentioned in a previous slide, to take into consideration not inflating the impact, the revenue impact of a fines and fees reform. And so that means making sure that you're looking at what's actually being collected and coming in, not all the money that's being imposed that might not be collected at the end of the day. It means looking at volatility over time to see if it is a stable or unreliable revenue source for governments. And it means looking at not just the revenue change that you may see from eliminating a fine or fee, but also looking at how the cost of the status quo that governments incur to maintain the fines and fees system would change and potentially result in savings that would offset any revenue loss. Okay, so then after you kind of figure out how big of a revenue impact we're actually looking at here, conversations may come up about how do we mitigate that revenue impact. And we're first and foremost going to talk about some strategies that governments can use to do this without finding new money, which is like everyone's favorite thing, right? So what that usually involves is having the public agencies or departments that were previously collecting the revenue and using it to fund certain services and operations, having them do what's called in budget speak, absorb the revenue impact, or reallocate the dollars that they do have, taking into account that they have slightly fewer dollars coming in from fines and fees, and essentially doing more with less. And sometimes this is like a really feasible thing for government agencies to be able to do. Sometimes it's a really hard thing. And that has to do with how much wiggle room they have in terms of, is there underspending going on? Are there savings in the department somewhere that make it possible to stretch the dollars out a little more and absorb that revenue impact? And so as an advocate or a stakeholder who's not sitting directly in a department or has access to like internal financial documents, some ways that you can understand and look for clues about sort of how feasible this idea might be of a department absorbing the revenue impact of a fines and fees reform are the following. You can ask yourself some of the following questions. One has to do with, are there high vacancy rates of unfilled full-time employee positions, or FTE, in the department that have persisted over time? And this is because each agency, it's in state and local budgets in every jurisdiction, get assigned, authorized, and usually funded for hiring a certain number of full-time employees. And if the department doesn't hire all the people to fill all those positions, usually that payroll money just sits there and can result in accumulating savings at the end of the year that have not gotten used. And if that amount is significant, and if those vacancies persist, not just in 1 year where there might be like a blip, a lot of turnover, but the positions are going to be hired in the next year, no problem. But if those vacancy rates are persisting across a number of years, long-term, it could make sense. It could be feasible for the department in a future budget to reallocate those dollars in a way to help cover any other holes that may be left by changing a fines and fees revenue stream and ensure that operations for the department are not disrupted. A frequent place that you'll hear FTE vacancy rates discussed is during budget hearings at the point of the budget development process, which is for many state and local jurisdictions going on right now, where legislators are reviewing the governor or mayor's proposed budget and making decisions on what they want to change before passing a final budget. Usually agencies have to go and do briefings, hearings, provide materials to help explain to legislators what's included in their proposed and recommended budget and what they're asking for in terms of changes. And vacancy rates come up a lot here because legislators similarly are trying to use this to gauge and assess, like, does this department have a lot of savings? Do they need more money to do things, or can they use the money that they have? And so trying to tune into budget hearings or looking for the associated documents can be a really good way to be able to identify what may be going on with those vacancy rates. More broadly, you can also just look for other ways, other clues that could tell you whether a certain department or agency has overall savings that are building up in the current year, either because they have more money coming in from whatever sources than they thought they would when the budget was originally programmed and passed, or because they're spending down less than they thought they would when the budget was originally passed. Those savings, if they're not used, can accumulate into something called fund balance, which then can be used to reallocate to future years as a one-time source. But the existence of that fund balance or the existence of that of those savings projections can also help you identify, oh, this might be a department or this might be an area where it won't hurt them a lot to lose a little bit of money coming in from fines and fees because they're not even using all the money they have right now. And again, this is helpful to kind of look over a multi-year period and not just at a 1 year and not just at a 1 year situation where there might be a blip or a special situation. And again, budget hearings and like the budget development process is a key place where you can find reports that talk about these savings. Your comptroller or controller's office often will do either annual or quarterly financial reports that may project out, okay, we're halfway through the year and this agency is looking like their savings is going to be this amount by the end of the year. So there are a lot of different financial documents that you can try and use to kind of see those clues for yourself. One last bullet point that I'm not going to touch much on now because I want to wait for an example slide that I think gets to the heart of it is you can also consider, instead of looking for places where they may be underspending that can indicate that a department could absorb the loss of a little bit of revenue, you can also think about and engage in conversations around, are there other revenue streams and areas where we are losing revenue that can be minimized or that can just help contextualize why also losing a little bit of revenue for fines and fees reform purposes might not be a big deal, might not make the sky fall, might be 100% worth it, again, for people and for budgets. And I'll show you an example of that in just a moment. Okay, so you all who have watched previous webinars know I like to use lots of screenshots of different state and local budget documents to sort of show in concrete form the concepts that we talk about. Today's no exception. The first example I want to show you comes from New Mexico's Legislative Finance Committee, which is the fiscal body in the legislature that reviews the governor's proposed budget every year and departments' proposed budgets, and then makes recommendations on whether they think those proposals should hold or whether anything should be different. So this is coming from their recommendations for the fiscal 2025 budget, which is the period we're in right now. And this is specifically looking at their recommendations on the Department of Corrections budget. So this is a screenshot with a lot of words. I know it's very small. Don't worry about reading all of them, but I highlighted sort of just the concrete example that I wanted to show. And that's that the Department of Corrections initially requested for this budget an increase of almost $22 million to do a number of things that they said would just take more money in their budget or enact new services. And they asked specifically for general fund money to do that. So new revenue coming into their budget. Instead of saying, yes, these seemed like important initiatives, let's go ahead and make sure we add general fund. Instead of doing that, the official recommendation from this fiscal office was to reallocate the vacancy savings to support the increases in costs that the department is saying they need. And they back that up by saying, based on the projections that we're seeing, we think that this department's going to have over 32 million in vacancy savings in the current year that we're looking at. That's even more than the total amount of new money that they had requested. And remember when I was talking about how it's important to look at a multi-year view instead of a one-year view, they do point out that there are long-term trends in these high vacancies. It's not just one thing they're seeing just in fiscal year 24. And so they're saying, we think it makes sense to let them do the things that they want to do that would need more money, but that we can reallocate those vacancy savings instead of having to add new money to do it. So a very concrete example of reallocating vacancy savings. Our second example comes from Colorado. In 2021, Colorado passed HB 1315, which eliminated all juvenile fines and fees. And the fiscal note for that bill initially laid out what they thought was going to be the loss of revenue no longer coming in from those fines and fees collected of about $1 million. And then they also mentioned that the bill would vacate or discharge old outstanding debt from unpaid juvenile fines and fees to the tune of over $10 million. And so while the fiscal note did say, okay, there might be a $1 million hole here, in the Colorado state budget from the implementation of this legislation. And they did partially recommend backfilling or replacing some of it with general fund. They also took a couple other things into account, which I think are important to hold up. One has to do with looking at the cost of collections, which I don't see a lot of fiscal notes. I don't see a lot of states doing this. It really depends on the level of access and transparency of data reporting that offices or stakeholders or lawmakers have access to, as well as sort of capacity for who is writing fiscal notes and how much capacity there is in fiscal offices. But in this case, there's a fiscal office, and the fiscal analyst was able to quantify savings that would come about as a result of no longer having to maintain the system of collecting juvenile fines and fees. So they mentioned this reduced workload for staff who would no longer have to create payment plans for collecting these fees. And they came up with a quantifiable number that they said represents about half a full-time employee's salary at about $35,000 per year. And so even though that is small comparative to the revenue loss, it still does offset, it still does reduce the feeling of loss that the state would incur from having a revenue impact from this reform. And then the other really important thing that I think this fiscal note does to point out is in addressing that $10 million of outstanding fines and fees that is vacated and no longer will be sought to be collected, the fiscal note recognizes that they can't really assume a backfill or an amount needed to make the department whole for that money, because they don't know when or how much of that money would ever be collected in the first place, because it's outstanding debt. And so they say without a backfill, they just assume, and they use this fancy budget speak to say that any reductions in appropriations to programs supported by the affected cash funds would be accounted for through the annual budget process based on annual actual revenue and available cash fund balances. And that's just fiscal speak for basically saying, we are going to assume that the department can figure it out, that $10 million won't actually make a huge impact on this department's budget, because we don't know how much, if any, would have actually been collected in the first place. So we assume they're going to keep an eye on what's coming into their budget, an eye on what's going out, to make sure that they can still stretch their dollars and make it all work. So again, a really concrete example of setting the expectation that the state or a department can absorb the revenue impact without adding new money. The last example that I want to look at today comes not from a government source, but this actually comes from a nonprofit called Good Jobs First. And this nonprofit has an exceptionally cool, I think, tool that they have free and accessible for anyone to use called a tax break tracker. And Good Jobs First promotes corporate and government accountability and economic development, especially around the use of public subsidies. And so what they do with this tax break tracker is they compile information by going through very detailed financial documents for every state and local jurisdiction in the country, how much money on an annual basis that governments are essentially giving up through tax break or tax abatement programs that they use in economic incentive packages. So whether that may be trying to incentivize a certain business to move their headquarters to a certain jurisdiction by saying you won't have to pay property tax for X number of years, or incentivizing housing developers to build affordable housing by creating tax breaks associated with the building of affordable housing, what have you. And I hold up this example as an example of a place where you could look for comparable types of revenue where you may see some losses, but the overall legislators, because they have passed this into existence, has decided that it is worth it in the grand scheme to lose a little bit of revenue in order to help money flow into local economies, in order to promote employment and good jobs for the folks in that jurisdiction, et cetera. And it might be a helpful comparable example to hold up when you're trying to help legislators feel okay about the fact that there might be a little bit of revenue impact from a fines or fees reform, but similar to how often economic incentive packages are talked about is for sort of the greater good of the jurisdiction, because it promotes putting money back in people's pockets, infuses money back into local communities, has tremendously positive effects for communities and for the people who are having to pay that money. It also could be an area if it feels productive for your particular context to have a conversation about, okay, well, we're worried about revenue loss over here. Are there other areas to make up for that where we could minimize revenue losses that are currently being incurred? And so I think this is just like a really cool tool that can be useful to those conversations. And to show you a quick example of how it works, I just typed in Illinois into their tax break tracker and clicked on 2022 to get a summary. And you'll see it details for me by all the different cities and counties in Illinois, how much in revenue loss each jurisdiction within Illinois is essentially giving up through these tax break or tax abatement programs. And then if you click on the links, you can see more detailed like program descriptions. So you can distinguish between like what kind of programs are creating those tax break programs. So again, and like you can see these numbers are not small, they're very big. And again, compared to the grand scheme of what revenue impacts for fines and fees reforms often looks like, very, very different. So could be a helpful example to hold up, again, totally dependent on jurisdictions, your relationship with particular legislators. This is not to say that any one tax break program is good or bad, but just might be a useful strategy to have those discussions about revenue impact and mitigating the worry of those impacts. Okay, so we've talked about a lot of ways that you can mitigate revenue by potentially not having to come up with new money. But when push comes to shove, sometimes we know, probably many of you have experience with legislators or policy members being so concerned about potential loss of revenue in a certain place in their budget that they say we would need to find a way to make the department whole, to come up with new revenue to replace revenue that would be lost from no longer collecting fines and fees. And so there are certainly some strategies here that, again, can be harder in times of tighter fiscal conditions, but certainly not impossible. The first one I'll bring up is the general fund, and it's the first one I bring up because it's everyone's favorite fund, everyone's favorite bank account. We go into the general fund in a lot more depth than I think like all our previous webinars. So I won't say too much about it here other than it is lawmakers' primary discretionary fund in state and local jurisdictions where they get to decide exactly how to use the dollars and where to put the dollars. And so because of its discretionary nature, and it is such a big fund in almost every jurisdiction, it is often the go-to source when people are trying to figure out like, okay, we need to come up with new money, new revenue somewhere, let's plug general fund in. The downside to trying to use general fund as a solution for backfilling fines and fee revenue is, of course, that everybody wants a piece of it. And there are a fixed number of dollars in any one general fund pot. And so the tighter the fiscal conditions are looking and that the budget deficit might be looking in your jurisdiction, the more intense and the more political that negotiations around prioritizing investments for that general fund may be. So how useful it is to pursue sort of a general fund backfill can certainly depend on jurisdiction and sort of the number and level of priorities and trade-offs that lawmakers are looking at and where you think fines and fees reform can fit in that. One-time sources often get brought up as a potential way to deal with revenue impacts of reforms as well, which I think can be helpful, but I say isn't a permanent solution and should be looked at with a healthy amount of skepticism because they are one-time. And so if there is money that's being collected from a fine or fee every year and you are trying to reform so that that fee is no longer collected, you are going to need a revenue and you want to backfill it with like an actual revenue solution. You're going to need a revenue solution that can replace that revenue year after year after year. And one-time sources, these are like your government reserves. This is your fund balance that builds up from a past year of underspending. This is your one-time federal money. One-time sources can be really helpful to do like what I like to call soften the revenue impact. They can help in maybe the first year, or if you spread it out, maybe 2 or 3 years. But eventually what you're doing is kicking the can down the road, and you're going to find yourself in the same problem and dilemma a few years down the road and have to sort of solve that through that revenue conversation again, which again, maybe is a solution at some points, but is not necessarily a sustainable solution for thinking about budgets down the line. And then lastly, we have alternative revenue streams. So these are all your different, usually types of tax streams that come up in state and local governments, and which could be, again, super dependent on your jurisdiction, context, and the way legislators are thinking about revenue in your jurisdiction, but could be a useful source to tap into or conversations to be a part of when considering, can they be useful sources to help replace or backfill revenue that was coming in previously from a finer fee that I'm trying to eliminate or reform. And we are not here at FFJC to tell you this is a good tax stream or this is a bad tax stream and you should have these conversations. But what we want to do is equip you with the information to help you evaluate and know what to consider if you find yourself in these conversations and thinking about alternative tax streams. And this is where I no longer become the right person to talk to about this, because Kamolika Das, who is on this webinar with us, is much more an expert on this than I am. She comes with years and years of tax policy expertise and is now the local tax policy director at ITEP. And I am now going to turn it over to her to talk to you a little bit more about what we are currently seeing in terms of the most popular or more talked about alternative revenue streams and tax streams that are coming up, and some principles and questions to consider, again, when engaging in conversations about these possible alternative revenue streams. So I'm going to stop sharing my screen from there and turn it over. Stop sharing.
All right. Just share my screen now. There we go. All right. Well, hi, everybody. It's great to be here. My name is Kamolika Das, and I am ITEP's local policy director, as Lillian just said. So ITEP Institute on Tax and Economic Policy, on Taxation and Economic Policy. We're a nonprofit, nonpartisan tax policy organization. We just conduct rigorous analyses of tax and economic proposals and provide data-driven recommendations to shape equitable and sustainable tax systems. So this is just a little bit about us. And we are based in DC. I'm personally based in Philadelphia. All right, so Lillian already mentioned some of this context, but I want to point out that trying to find more revenue sources will be important, like more important than ever, and just not in the fines and fees space overall. States and localities are already facing higher expenses and tighter budgets due to many reasons. Just even like higher interest rates on debt service payments, pension costs, construction costs. Inflation also impacts things like gas for police cars and fire trucks. I mean, just all of it. And then on top of that, the fallout from the pandemic continues to hurt commercial real estate prices, and then that hurts property tax revenues. Plus, we have the ARPA funds expired. And then in addition to all of that, a lot of these new federal policies could have significant revenue implications. So the 2025 tax bill could include new proposals that would significantly narrow the federal tax base. So that's not actually in here, but this is a huge deal. So if the tax code no longer taxes overtime or tips or car loans or what have you, that definition will then trickle down to most state tax codes as well. That would be the new starting point. And so any type of state tax revenue would be massively reduced. And so, and then on top of that, we're likely to see massive changes to Medicaid, SNAP, and other federal assistance programs. Just again, for context, across the states, more than 2/3 of Medicaid dollars come from the federal government. So states would have to absorb any type of Medicaid cuts, such as high prescription drug costs. Also keep in mind that in a lot of rural areas, their biggest employers are public schools, so education cuts would disproportionately hurt those economies. It's impossible to state all of the state and local revenue implications of the federal policy changes, but safe to say that they would need to raise a lot of money just to maintain the current services and like offset any cuts to housing, food assistance, healthcare infrastructure, and so on. And so, given that background, there have been numerous tax commissions and task forces that have been examining their existing tax structures to figure out what to change, how they could raise revenue. So, these have been in Pittsburgh, Scottsdale, Arizona, DC, Cincinnati, Salem, Oregon, Seattle, here in Philadelphia. I'm sure there are others that I'm missing. It's worth looking at some of these reports if you're looking for like very specific policy ideas, which I'm not going to have the time to really dig into. I would say the one from Salem, Oregon is really helpful. Obviously, the one from the DC Tax Revision Commission. There are a few that are like worth looking at. Okay, so what principles should you consider when you evaluate different types of taxes? When you're having conversations either internally or with lawmakers, it's important to just be aware of the principles that comprise quote unquote good tax policy. And so here are the ones that I kind of mentioned. On the left here, stability is actually more of a part of adequacy, but anyway. Okay, so first off, equity or fairness. So does your tax system treat people at different income levels and people at the same income level fairly? So there's, I guess it's a little wonky, but vertical equity that addresses how people at different income levels are treated, rich to poor. And then horizontal equity asks whether people who make roughly the same amount of money are also treated fairly by the tax code. And so this is just an illustration of equity and fairness. These are economic terms. There's no judgment here necessarily. It's just more of, these are very strictly, it's almost like formula based. Is a progressive tax is one which upper income families pay a larger share of their incomes in tax than do those with lower incomes. And then, you can just read these on your own. But these pretty much, I would say that our laws aren't always aligned with these principles. Just to give you an example of that, federal tax law taxes long-term capital gains at a much lower rate than regular wage income. And so one could argue that that violates horizontal equity, since the tax system then hits wage earners more than anybody who's getting their income from wealth, despite having the same total income. So that's just one example. Adequacy is just, does the tax system raise enough money, like in the short run and in the long run, to finance all of the public services that we would like to have in our society? So stability, so again, that's kind of part of adequacy. A stable tax is one that grows at a predictable pace. But stability by itself isn't really enough to achieve adequacy in the long run. You also need elasticity, which is a measure of whether the growth in a specific tax actually keeps up with the economy. And this is important because generally speaking, most taxes, they don't necessarily, you don't get to increase that revenue at a higher pace than like the government costs. So it's an important factor, the elasticity. And we can go into it later, but then elasticity and stability, they're sort of a little bit in tension with one another as well. So simplicity, does the tax system actually allow confusing tax loopholes? Is it easy to understand how they work? It is important to be a little careful of this language, because often arguments to simplify the tax code could become red herrings, and they're often used to adopt policies that might potentially violate other principles. For example, replacing a graduated income tax system with a flat tax seems a lot simpler, but actually having different rates is really just, one line on your tax form. It's easy to calculate, but then that would typically compromise both fairness and adequacy. So be careful when you hear the simplicity language, but it is an important thing to consider. Exportability. So this asks if the tax is at least partially paid by non-residents, since individuals and companies often benefit from out-of-state public services, such as businesses that hire, a state's high school or college graduate, and or like tourists who use a state's transportation infrastructure. It's just acknowledging that, you don't necessarily have to live in a place to accept all of the public services that they provide. And then lastly, this neutrality or efficiency, it essentially states that taxes should be designed in a way that doesn't distort economic decisions or create unfair advantages for certain behaviors or groups or industries. Just as an example, back in the early 80s, the Reagan administration gave out big tax breaks for commercial real estate, and it led to a lot of development of office construction, and there were too many that were built, and a lot of these offices sat empty. And so it just led to a misallocation of resources. Before I keep moving on, I just want to be clear that just because a particular tax, doesn't exactly meet or violates one principle doesn't mean we shouldn't adopt it. These are just sort of a lens with which to evaluate different taxes and see what the right balance is. It's also a main reason why we should have a diversified stream of different taxes. That's why, and you can kind of see in the next slide, that this is the big picture of how states and localities raise their tax dollars. So this is like why most states and localities depend on different types of taxes. And this is all looking at all states together, but the slices can vary a lot by state. I mean, there are certain states that don't tax income at all, or it's much more heavily rely on property taxes or sales taxes. So these are the major tax types that are levied. They're on what you own, usually the property taxes, what you buy, like a sales tax or gas tax, or your income. And so in reference to the principles that we just mentioned, the property taxes tend to be very stable, but not very elastic. They're very stable because it's hard to hide your property. It's an easy thing to collect. So it's very reliable, but they're also less likely to capture really sudden swings in the economy, like income tax revenues. They fluctuate a lot more like year to year, but then have better long-term stability because it does capture a lot of those changes in the market. Income taxes are also favorable from a fairness perspective, because they are the only major tax that's based on a household's ability to pay. If you think about it, property taxes, in some ways it is, because, like you would assume, like the more wealth you have, maybe you have a higher property home, but then if you suddenly lose your job, it doesn't really change your property tax payment. And so in that sense, and then sales tax, regressive, because that's not based on ability to pay at all. So yeah, if you think about from that equity fairness perspective, that really is why we think that the income tax is important for meeting that principle. Okay, so here are some of the common tax options we've been hearing about. These are ones that have come up in a lot of those tax commission reports. We don't have time to individually talk through all of these, but just as an example, we can discuss a couple of them. I think the CEO pay ratio one is really interesting because on its face, it seems like really good policy and a way to encourage more fair compensation. For example, the one that I'm thinking of, it's, companies that pay their CEOs more than like 100 times more than the average worker has to pay like a certain tax. But from a neutrality perspective, these kinds of policies tend to actually favor certain industries. For example, a hedge fund, which actually has a relatively low CEO to payer worker pay ratio because they primarily hire people with elite educations and very specific skills, over companies like Walmart or McDonald's, which have a much higher ratio because they hire a lot of lower income people to serve customers. And so it can also create a lot of market distortion by incentivizing companies to replace low-paid workers with contractors or offshore employees. A soda tax that's written here may be very efficient, but it disproportionately impacts lower income individuals. So it's less desirable from an equity perspective and a neutrality perspective, since it specifically targets sugary drinks instead of, a certain type of food or drink items or other drink items. And then I'm going to go into a little bit of a deep dive on sales taxes, just because this is something that I've been hearing a lot of proposals of increasing sales taxes. Sales taxes might be desirable from an efficiency standpoint, mostly because they're really easy to collect. They're really straightforward for businesses to administer, for people to pay them. You don't need any complicated calculations. However, from an equity or fairness perspective, they're very regressive since they take a larger share of income from lower income individuals, mostly because, and this just kind of illustrates that, because lower income individuals typically spend a higher portion of their income on consumption. So if you're paying almost all of what you make on things that you buy, you're paying, more taxes on your income, essentially, compared to higher income individuals. And so often people think that adding exemptions to sales taxes can help, if you exempt food or diapers or anything that you need, and that can help align them with tax principles. And that's true to some extent. So adding these sales tax exemptions, they can reduce some of that regressivity. But you also have to keep in mind, and this is always the balancing act of looking at these different tax principles, that would lower the regressivity, but then that would also deeply hurt the adequacy of those tax systems. So then you'd be bringing in a lot less money because you're like creating these big carve-outs. And if you create the big carve-outs, they're not targeted, they're not necessarily just for people with the least means, they're for everybody. And so, it just doesn't really, it makes you wonder, like, is that the best use of your money? And so then there are things that policymakers can do to make sales taxes a bit more aligned with tax principles, such as like broadening the sales tax base so that all goods are taxed the same way. Like the Supreme Court Wayfair decision helped with this because now states can tax like online retailers out of state, or policymakers can adopt rebates or sales tax credits to help lessen that regressivity. And the reason, again, like I spent a lot of time talking about sales taxes because there's a big trend to partially replace property taxes with sales taxes. And from an equity perspective, that would be kind of damaging to lower income families, and it would introduce a lot of volatility, making it harder for policymakers to budget. Also, policies like across the board property tax cuts unintentionally have a negative impact from a neutrality perspective because the property tax cuts can reduce the supply of homes and make it harder for younger people to even enter the property ladder. So ITAP cares pretty deeply about all of the principles that I named. We focus a lot on equity and adequacy just because those are the ones where our tax systems are often the most behind and where we need to do the most work. On this page, I just listed some of the resources that you can take a look at, and but please don't hesitate to reach out as well.
Awesome. Thank you so much for that, Kamolika. I hope that I know that was a really valuable discussion for me to hear as someone who is not necessarily a tax policy expert. And we hope for all of you that it is helpful, not because we expect that you all will go out and start advocating for certain tax policy changes, but if you are in a conversation about a fines and fees reform, revenue impact, and you're hearing, oh, well, this will be more than offset by the increases in sales tax that we expect to see over the coming years, we hope that you now have some additional tools and sort of contextualization strategies to engage in those conversations in a productive way that is helpful to the success of your reform. So thank you very much. At this point, we are going to go ahead and just open it up for any other questions that folks may have about any of the concepts that were discussed for either myself or for Kamolika in the webinar. This is an interesting question that just came up about would it make sense to talk about like user fees in contrast with the word taxes, because fees often do get talked about as taxes a lot, sometimes because they are an explicit way to raise revenue. They are explicitly used to raise revenue. And so I think like, and a lot of times I think they have the same purpose as taxes, but I think the concept of fines and fees and how we think about fines and fees often like as a society differs from how we think about like tax base that we collect from everyone, which is why I think like I'm generally careful when to not like always conflate the use of the two terms. I don't know, Kamolika, anything for you to add there?
Yeah, I mean, I think they do have more specific definitions. Like usually fees are levied to fund very specific services, whereas I think generally, taxes, we think about it as to fund shared services. And I don't think that's like strictly true. I mean, obviously, like certain luxury taxes, that's not always true, but I think that there are scenarios in which, yeah, you might not want to conflate them. But I think if it helps your argument, depending on whom you're talking to, I think it, I think it isn't necessarily harmful.
And I will say at FFJC, like we advocate strongly for the elimination of all fees in the justice system because we know that they are explicitly used as a tax or essentially as a regressive tax, as a way to generate revenue. And we don't believe that specifically justice-involved people should be exploited in that way to build upon revenue bases.
Yeah, I think, that's a really great point, because I think that is kind of the fear of like these massive across the board tax cuts, that they predominantly are pretty inequitable. And then because you're not gathering as much funds from your higher income folks, you have to then shift it, like a lot of that onus gets shifted on your lower income folks, and you have to raise fines and fees. So anyway, yeah, I think that's a great point.
Another question came in about, with some of the equity measures included in marijuana legalization being struck down or rolled back, we explored redirecting any of those potentially unused funds to covering some of the costs of rolling back fines and fees. I'm glad you brought up this one, because this was one when I used to work in budget offices. It was when like there were a lot of different jurisdictions that were newly for the first time legalizing marijuana and starting to collect that revenue. And what I found from like my position in the budgeting world is that when a new revenue stream comes in, there usually is a plan to sort of generate how that revenue is going to be used. And it is, I think, most helpful, most useful if you are trying to make sure that a certain type of cost or a certain offsetting of revenue impact like is part of that plan for the new revenue stream, that happens at the beginning. Because once plans are often like made and budgeted, then it just continues year after year. Okay, well, we know we spend marijuana tax on like X, Y, and Z types of things that impact public health. Sometimes those are like dictated by statute. Sometimes they are not as much.
Yeah, I could put this report in the chat. It was one that when I worked at the DC, when I worked in DC, one of my coworkers wrote this report. Oh, I don't know if I can put it in the chat. But this is one where it was basically an idea of how to use cannabis revenue for rolling back like fines and fees and just other efforts to kind of help with economic justice. I see there's another one right here.
And the one last thing I'll say about redirecting any potentially unused funds there, it's just always important to be aware of for tax streams or any other revenue streams, if there are restrictions around what you can use that for. So for example, I'm thinking about a jurisdiction that I know where marijuana tax specifically had to be used to address like different types of spending for public health. And so there were restrictions around it where you can't just put dollars exactly wherever you want to go. And that doesn't mean to say it can't be a useful strategy, but just something to be aware of. Okay, I see another last question related to, or a couple questions, but one related to vacancy taxes, which is probably going to be a question for Kamolika.
Yeah, I was going to say, we are planning, I mean, this is probably 6 months out, but we do have a vacancy tax brief planned that we're going to publish. So I don't know, stay tuned. I will say I haven't heard as much about about using fees for the same, but anyway, there's like some interesting proposals that are happening right now. Like there's one in Hawaii on vacancy taxes. So sorry, I know that doesn't answer your question directly, but we'll have more soon.
And then the next question about using revenue from confiscated items like drug-related arrests, tax frauds arrests, etc. I would just say the same framing about often these types of revenue streams have restrictions on how they can be used. And so that's just important. I think a good way to find out what those restrictions are is to check statute language. Often either statute around the specific revenue that's being set up or the specific fund that the revenue goes into can be good places to understand what kind of restrictions there are or aren't on that revenue, or whether it's more widely used like for the general fund, in which case it kind of just goes into the big discretionary pot of general fund. I think we are at time. Oh, I see one more question coming in. We are at time, but we will try and get through this last one very quickly. And if you have to jump, no worries. We will again be putting this up on our YouTube channel for people to access at any time. Curious a question about the long list of user fees that fund government, an analysis of why legal system fees are different in kind. So yes, user fees can range far beyond those that, like specifically at FFJC, we work on that touch the criminal legal system. Those user fees differ by jurisdictions, sometimes in revenue reports where they forecasts on different revenue types per jurisdiction. You'll see like very detailed lists of all the different types of user fees. Sometimes you'll just see something that says like fees and licenses or something like that. So it differs widely from jurisdiction to jurisdiction, but happy to follow up on this question for a specific jurisdiction if someone has that question.
And I was going to say, the census also does report some non-tax revenues like user fees, especially like non-justice related fees, if that's helpful.
All right, I think we're going to go ahead and close out the question period and just say thank you very much to everyone for tuning in. We really appreciate you being here. We really appreciate the work that you all are doing. And we hope that this has been a helpful webinar to equip you with some new fiscal strategies